With the increasing cost of education, a new legislative measure known as the One Big Beautiful Bill is set to take effect, restricting the amount of federal student loans available to college students starting next year. This significant change will potentially force many students, particularly those pursuing higher degrees like medicine, to rely on private loans to finance their education. The implications of this shift are profound, as borrowers may find themselves handling riskier, less manageable debt. The average medical graduate student will face a daunting reality. They will likely be unable to secure sufficient federal loans to cover the astronomical costs of their schooling. Consequently, they might need to take out tens of thousands in private loans to bridge the financial gap. This situation is not only concerning for medical students, but also for families considering Parent Plus loans. These loans typically have higher interest rates, and families may find themselves burdened with almost $5,000 more in interest during the repayment period. As federal loan limits tighten, more students will be inclined to seek out private loans to fund their education. Starting with the academic year of 2026-27, the One Big Beautiful Bill will institute these borrowing restrictions, leaving many students to find ways to cover the costs of their education. Advocates and experts have raised alarms about this move, suggesting that it may compel borrowers to seek private loans, which often do not qualify for federal forgiveness programs. Not only are private student loans harder to pay off, but they also come with higher interest rates compared to their federal counterparts, making repayment significantly more expensive over time. Proponents of the lending caps argue that by limiting federal aid, colleges and universities will be incentivized to reduce their tuition fees, which have been steadily rising for decades. However, data gathered over the years suggests that this argument does not hold water. Instead, it appears that students and families will be driven deeper into a cycle of expensive, risk-laden private student loan debt. The ramifications are particularly severe for medical students. The recent bill has curtailed the existing loan limit for non-professional graduate students from $138,500 to $100,000. For reference, the average graduate borrower with a master's degree holds about $80,550 in student debt after inflation adjustments. Although the bill has increased the loan cap for professional students, including medical and law students, to $200,000 over the course of their education, this still falls short of covering the average cost. In fact, the average medical student graduates with approximately $232,100 in student debt. Previously, graduate students could rely on Grad Plus loans to manage their remaining costs, but this program will be eliminated after July 1, 2026, leaving many medical students with no choice but to turn to private loans. It's worth noting that private loans often carry varying interest rates, some reaching as high as 17.88%. This is a stark contrast to the Grad Plus loan interest rate set at 8.94% for the 2025-26 academic year. Additionally, changes to Parent Plus loans will also have repercussions for undergraduate students. The new bill limits the annual amount parents can borrow to $20,000 with an aggregate cap of $65,000. Historically, many parents have exceeded this threshold. In 2020, over 17% of Parent Plus borrowers borrowed more than $65,000. These significant changes present challenges for families and students alike, especially those in degree programs that may be seen as risky in terms of repayment defaults. As institutions gain more power to regulate the amount of federal loans based on perceived default risks, it's unclear how this will ultimately affect students pursuing fields like education or public service. In closing, the implications of these legislative measures will unfold over time, but their immediate impact on borrower options and financial burdens is already a cause for concern.